Hey everyone. As promised, today I'm doing a follow-up on the previous video about my whitelist generator. As a quick reminder, I now have two accounts. One of them is constantly running some emulated active markets algorithms to collect data without interfering with real trading. I am feeding the resulting reports into a fresh new spreadsheet where the data is parsed and analyzed, and the whitelist of coins for each side and distance is generated based on my criteria, ready to paste into MoonTrader algorithms. Today I'm going to discuss how exactly I'm planning to use this, what its limitations are, and what its other purposes might be, except for generating lists of coins. The original intent was to just generate these lists, update them every few days based on the new data collected, paste the lists into real algorithms, and run them. At first on minimum order sizes to just prove the concept, and then, if all goes well, raise the order sizes to try and earn some actual money. With the system set up and running, I wanted to move on to studying other things in MoonTrader, such as other types of algorithms. But it appeared to be not as simple as that. There is one screenshot that opened up a whole another can of worms for me. Look here. This is a graph for Anchor, and this graph made me think. And thinking is a two-edged sword. On the one hand, it opens you up to new ways of looking at things, while on the other hand, the downside is that it may prevent you from taking any actual actions based on what you already know. You'll see in just a bit why I'm talking about this. So, why are we looking at the graph? Well, look here. On the left side of the graph, we see that up until a certain point, the graph was pretty flat. Then there is a large spike in trading volume and hence in the price. Then the price fluctuated for a bit and gradually settled down at a new level. And here you can see that further down the road, one of my algorithms placed an order and successfully made a trade at what I remember to be about 0.8 distance. The key thing to note here is that the active markets algorithm was sleeping on this coin while it was flat. And then it woke up once the volatility increased and Anchor became one of the most active coins on the market. If the sell order had been active here on the flat, then I'm not sure what the results may have been. First of all, the size of the shot is pretty big compared to the distance of 0.8%, and then there's another one and another one all going up, which may have not given my order enough of a rollback to close the trade with a take profit. You've all probably seen this type of thing. The price keeps going up and eventually it reaches your stop loss. And sometimes that happens during yet another shot, and your stop loss gets squeezed even further into the losing direction. Now think about the algorithms that I was going to create based on the active markets data analysis. They likely would have been static, meaning that they would place orders on the whitelisted coins regardless of the situation on the graph. And they would have opened the position right here, right after this flat section, and they would have likely been squeezed into oblivion by the rising price. So I decided to check what the stats are actually telling me about the level of coin volatility while the coin is one of the most active markets. Here I have added this little summary on top. So for all of my new data collected so far, which is 796 trades, the minimum 3-minute absolute volatility was 0.2%. The average was 1.87, while the max is in the 20s. Okay, so obviously my data is telling me absolutely nothing about the behavior of the coin when its 3-minute absolute volatility is below 0.2%. So I went further and decided to chart out all the different levels of 3-minute coin volatility to see where I have the most representative data. Here is the table. In this first column I have volatility groups in steps of 0.3%. Then I have the number of trades for each range in my stats, the percentage of the grand total for that number of trades, and the running total in percent. What does this all tell me? It tells me that below 0.3% in volatility, I have nearly no data to judge coin behavior. Only 7 trades, which represent less than 1% of the total number of trades. Then it gets more interesting. Each new range gives me more and more significant data. Now, here I will refer you to our good old friend Mr. Pareto. And I will go looking for a cluster of data that represents 80% of the grand total. And here it is. These 8 ranges with the most data represent 80% of the trades. Therefore, I may conclude that the data collected is more or less valid for the coin deltas between 0.3 and 2.7%. Okay, let's bump it up to 3%, just to make it roll off the tongue a little bit better. 0.3 to 3%. Fine. I made it also visual right here on the graph. The blue columns represent the number of trades in each range, and the green line represents the cumulative percent of the total. So the area of most interest for us is right here. You can see that before and after it, the number of trades drops off pretty remarkably. This raises the next question. Why are there so few trades on coin volatility above 3%? In my book, this level of volatility is more than modest. This could mean a couple of things. As you may understand, I only have the data for when there was a shot matching my algorithm distance. Hence, it is possible that there were few shots in that coin delta range, or that the coins entered that range for a rather short period of time, hence not so many shots. Or it is possible that very few coins entered that range for various reasons, while the others stayed pretty low on volatility. For that, I have built another quick pivot table. It shows what coins were active at which 3-minute delta range. As you can see here, from 3 to 10%, there were about 40 coins. However, half of all the trades happened on 6 of them, with perp being the leader with almost 20% of all trades. A close second and third are TRB and Starge. Weird things were happening to these coins in the given period. Uncharacteristically huge trading volumes. So, I made a pivot table with a breakdown per 24-hour volume. As you can see, TRB here was trading anywhere from under 100 million to over 1 billion a day. So I had to add the volume range into my report. For all different types of ranges actually, such as volume or volatility, I will have to work out for myself what cutoff points are actually meaningful and signify a qualitative change in the market, and which do not. Now, next, an underlying assumption is that the coin volatility is somewhat tied to BTC volatility, although this is not the only factor. So, naturally, I went to look for what the BTC volatility was in that period. In this little table, I summarized the data for each day, showing the numbers of trades, average and maximum 5-minute BTC absolute delta, average BTC 24-hour relative delta, along with the results of my emulated trading. Bitcoin was not too active in that period. The maximum detected 5-minute delta was above 1% only within 3 different days. The rest of the time it was pretty calm. Right, where am I going with this? As you have seen in the last couple of minutes, there's more data than I know what to do with. For now, I am organizing it into manageable chunks and cutting it in different ways to look for patterns. This, in effect, raises more questions than answers. As a result, I made this mega dashboard, where I can quickly filter the data in various ways to see on top how the major metrics are changing. Like, let's say, what if BTC was going up or down during the day? Does that mean that the sell side or the buy side is working better? And what is the most profitable coin group based on the 24-hour volume? Or at which coin volatilities I had more profits or more losses? And so on and so on and so on. Well, what started as a more or less straightforward whitelist generator intended to rid me of unnecessary manual work is now gradually turning into this monster with more and more pivot tables and more ways to filter and combine data. It also became obvious that the generator must be watched and its output must be interpreted before pasting any coin lists into any algorithms. Let me give you a quick example. Here I have a selection of different distances on the buy side. Now check this out. We see perp right here, and it's very much overrepresented. It is doing well at 0.5, 0.7, 0.8. However, it probably wouldn't be too smart to use a grid this tight, so close together, on the very same coin. Like one overly enthusiastic shot could bring me straight losses, 3 of them. That's putting too many eggs in one basket. And same story with Unfi here. Well, this whole train of thought came out of a simple screenshot, where the coin behaved differently while being flat versus while being volatile. And it also came out of me asking myself, what values should I put into the coin delta filter in the algorithm to make sure that it works better and more precisely represents the market conditions at that particular instant. I have even added the minimum and maximum 3-minute coin deltas across all coins included in this list for each distance and each side. Let's hope this helps. And there is still more data and more filters available in MoonTrader. Like here, the funding filter, what in the world is that? Or the 24-hour volume filter? What inputs should I use to better describe the desired market situation for this specific algorithm? Right now, I just don't know. And that's just the filters. Then there are different parameters for the order itself, for the take profit, for the stop loss, plus different latencies and delays. Again, more questions than answers. The reason I was talking about the downside of too much thinking is that all the while there has been no real trading going on, and my balance is still at 188. Now, however imperfect my whitelist generator output might be, I better plug in the lists into a few algorithms with minimal order sizes and just see what happens. So right now I have to prove the concept, watch out for inevitable losses, and try to figure out for each of them what I failed to take into account to make sure that it works, and then iterate and iterate. Wish me well. So, what have we learned today? Number 1, the more you know, the more there is to know. A strictly utilitarian analysis tool turned into a whole another research tool that raises more and more questions every day that I look at it. I'm not sure that I'll figure everything out anytime soon, and there's clearly no end in sight, but this will give me more incentive to dig deeper and deeper. Number 2, understand and describe the market conditions with filters. It may be obvious, but now it became ever more clear to me that an algorithm is not just a linear set of parameters. It contains 2 major groups, and one of them is describing what the market conditions should look like, while the other describes what the algorithm should do given those conditions. Right now I'm focusing on the conditions, and I have to understand all of the various filters available in MoonTrader to describe them. And then I'll have to tie them into specific actions that should be taken by the algorithm. Number 3, and this is a lesson I better learn myself quite deeply and quite soon. Take action when your knowledge is good enough. It may be imperfect, it may be incomplete, but there's gotta be a feeling somewhere that tells you that it is good enough for now, good enough to try. So let's see where this takes my balance. Great if it goes up, no big problem if it goes down. It can be fixed. At least I hope so. Well, that's it. I'm signing out for today. You all have fun. After so many spreadsheets, I know we all should.